we're investing in companies 2-3 million in revenue to about 15 million in revenue. So they, to a certain degree, they have product market fit. They've always had confidence they wouldn't be an entrepreneur if they didn't, but now they have a lot of data to support that confidence, and all the unit economics like CAC to LTV, churn, average contract value. So all these statistics and metrics that companies are tracking are heading in the right direction. And up until this point, they've raised maybe some angel funding, maybe a seed round, but they really aren't that 5, 10, $20 million raised business. And so they've hit this inflection point. And the earlier you dilute is going to be the most expensive dilution. That's just natural, just the way it works. And so our thesis is for you to avoid that or push that down the road. The companies we invest in can go raise equity if they want to, but they really don't want to for the two things that come with equity, which is dilution and loss of control. They really have a tough time getting bank debt because they are not venture backed and they're small and asset light. So they can't really find a place to get capital that's non-dilutive, but that also comes with help, et cetera, that you will get from an equity investor. And so that's sort of the problem we solve at the end of the day. And
if you're looking to drive revenue growth for your SaaS business, you have to invest into your go-to-market machine. Now, there are efficient go-to-market machines, there are inefficient go-to-market machines, and this is something we talk about inside this channel all the time, and I work with founders on in some of my coaching programs. But SaaS businesses come in all different shapes and sizes. Some are actually bootstrapped, where the customers that are buying actually funds the development of the company and the growth of the company and the go-to-market machine. There are also venture-backed companies that I work with, where they raise millions of dollars to actually fund product development, to fund their go-to-market, and to actually grow the company at much faster paces. Now, for the longest time, those were the only two options that were available. You either go at it alone and you bootstrap it and you fund it with another business or the customer revenues, or you go with venture capitalists and they fund the company and they take 20% of the company every single time and establish a board. There's no right or wrong here. It really depends on the market you're going after. But now there's a third option that fits right in the middle neatly. It's called royalty-based financing. It's also called revenue-based financing. And this is one of the things where I've seen some companies actually leverage this that I've worked with, and it's been an amazing way to actually grow faster without diluting the equity, meaning having to give away equity in the company. They raised money based on the revenues that they were generating, and they were able to get leverage on that, which is super powerful. Given that this is a big trend, given that venture capital is going through a flux right now, given that there are so many incredible opportunities for SaaS businesses to be run with efficient go-to-market machines and with a little bit of capital, they can actually grow a lot faster. I wanted to get someone on this channel. I wanted to interview him that knows all about royalty-based financing, knows all about revenue-based financing. So in this very special episode, I interview Vic Tupper. Vic is someone that lives here right in Dallas where I live, and we were very fortuitously introduced to each other. And once we met, I just knew I had to have him on the channel. So in this episode, we're going to dig into exactly what royalty-based financing is and exactly how they work with companies that are in SaaS, that are tech-enabled companies, that are tech companies to actually fund their growth with non-dilutive capital. They call it royalty-based financing. It's an incredible model. This is not a sponsored video by any means. This is just someone that I really respect, and he really knew about this model, and he was willing to come on and really talk about it in detail. And so I wanted to bring him on and share it with all of you guys that way, because all I really want is we're all building incredible SaaS businesses. And now you can choose whether you want to be bootstrapped or you want to raise venture capital, or you want to go with something like revenue-based financing or royalty-based financing, which we'll dig into more in this episode. And by the end of this episode, you'll know the exact principles that apply to funding your SaaS business efficiently, whether it's bootstrapping it or going through venture capital or exploring revenue-based financing. Intro. What is up, everybody? Welcome to our private Unstoppable Live. Vic, welcome. Really great to see you over here.
thank you. Thank you for having me.
Yeah, absolutely. First of all, thanks for doing this. Really excited to have you here. For a second there, I was like, maybe I should just come to your office, or we should because we're both in Dallas, which is, doesn't happen very often when we do these things.
You would have been more than welcome to come out here. I appreciate you having me on today. I'm looking forward to this.
Yeah, totally. So I'm going to give a quick background. So Vic is actually based here in Dallas, where I am, which is pretty special because I feel like it's like a small club of people that really get tech and are serious about tech, not just doing tech. He's managing director of Cypress Growth Capital, and they focus on royalty-based
financing specifically for SaaS businesses and also IT consulting businesses, which is super interesting. Quick tidbit for you, Vic. We have a lot of founders that are bootstrapped, a lot of founders that are venture backed, but we also have a lot of founders that are obviously all of them are starting SaaS companies, but we looked into this, about 20 to 30% of our founders come from an IT services background and they had domain knowledge and are now building a SaaS company. So I think it'll be really interesting to dig into all of that.
Yeah, and that's a pretty common characteristics of some of our companies where they started with a services business, found a problem to address with software, and the profits from the services went to build the software. And so then they had, a services business as well as a software business that helped them scale.
Yeah, we should talk about that more. So maybe let's just take it from the top. Tell us a little bit about yourself. And you obviously have this background spanning across venture capital, private equity, and now you're doing investments. Just tell us, how'd you get into doing what you do, and how did you kind of get into royalty-based capital? Give us the backstory first. I think everyone will really get value from that for starters.
Yeah, I'm born and raised in Dallas. I'm very unique, especially these days, in that I never left Dallas. You rarely meet people like me because of so many folks moving here. But I started my career after college in technology consulting. So I did that for about a decade. And business school is what got me interested in venture, private equity, et cetera. And that's when I made the pivot from technology consulting over to venture capital. So I did that for about 3.5, 4 years, believe it or not, for the state of Texas. The state of Texas back then had a venture fund to invest in early stage startups. So I sort of ran the North Texas side of things. So if you were looking for venture funding from the state of Texas, you would come and meet with us if you're based in North Texas. So that's where I got my feet really wet in regards to venture, assessing companies pre-revenue, which pretty much is assessing a team as well as an idea, and looking at the market and other characteristics. But it's high risk, high reward. Through that is when I met the founders of Cypress Growth Capital, Bart Goodwin and Ed Mello, who had just started the firm maybe a year, 18 months before. Really enjoyed what I heard in what they are doing. And in the course of business, I would just meet a lot of companies, and some of the companies I met, I felt were better suited for Cypress. And that's sort of how I formally got to know the founders. Is I introduced a company and they invested in it. And then I made the changeover in 2011 and joined Cypress in 2012, actually. And our first fund was in 2011. So at that point in time, we had only made 4 investments. And so I was very early on.
Here's the thing that I always wondered, and I think you're uniquely positioned to talk about this. We also have a lot of CEOs and founders that are from Texas. It seems like Texas, maybe even Dallas, has this unique history of starting early on a lot of interesting tech ideas, but didn't become like massive companies here, but became massive companies in Silicon Valley. But there was no shortage of like really great companies that grew up here, or like the idea was formed here. They were like the first ones to do it, but another company in the West Coast did it. But I always find interesting people, smart people working on really smart, interesting ideas here. What was it like being a VC in Texas in those early, say maybe like the Web 1.0 and 2.0, like during those years?
Yeah, I mean, it was very interesting because I was in Dallas and there wasn't really much venture, much investing. The angel activity now is much more active than it was back then, but it was really interesting. So entrepreneurs had to do a lot more with less compared to California, New York, Massachusetts, and and even Austin now. I mean, at least back then in the 2009, 10, and 11 range, there was a handful of funds in Austin. There was very few in Dallas. So honestly, you were meeting companies that had a little bit more traction because they sort of had to. They didn't really have the luxury of maybe raising capital, especially back then, given the capital climate back then. It was very hard to raise capital in general. You would probably have to pick up and move to one of the coasts to raise it, or give up a pretty sizable piece of your company back then, especially. But it was sort of nice because you got to meet companies that were a little further advanced, maybe had some revenue, et cetera, but still high risk, high reward, just given the nature of the game.
Do you think that's changed now? Like back then, it was like Silicon Valley was the place where high risk, high reward, huge failure, but also huge wins, and that's totally okay. Do you think now that Silicon Valley has been exported to all other places, like do you do a lot of deals in Texas? How do you think about Texas? Has the dynamic shifted?
We've made 46 investments. We closed on our 46th company today, actually.
Nice. Congrats.
And it's a Houston-based company. So we've done, probably 15 or so deals in Texas. So it's been a great market for us. But I think, California, even though folks are moving, California does still do most of the investing from a US standpoint. Obviously, Austin is catching up, or is increasing. I don't want to say catching up, but increasing drastically. But yeah, I think you don't have as many unicorns or $20 billion exits like we saw earlier this week with Adobe acquiring somebody, but you don't necessarily see those. I think what you'll find in Texas, or at least in Dallas, is entrepreneurs get to a size, and because they've diluted less, they may have a smaller outcome from a valuation standpoint because they haven't divvied it up so many ways. They may have the same financial outcome at the end of the day. You will have those outliers like we see in Silicon Valley, where it produces billionaires. You haven't really seen many of those in Dallas or in Texas in general. But I think Dallas, Texas, Austin, Houston, it's getting better. The number of unicorns are increasing year by year, but they obviously need to exit as well, right? Yeah. So that's the big question.
I think it's super interesting. I spent 10 years in San Francisco, and then I moved to Dallas 3 years ago, and I've met entrepreneurs on both sides. To me, it feels like it's a little bit of a different game. San Francisco or Silicon Valley is like, let me go raise capital, build a company. If it is successful, I will own 5 to 10% of it, but it will be a unicorn or a decacorn. And there's a certain percentage of likelihood of that happening there. What I've seen in Texas is, especially in software and SaaS, even consulting, IT consulting services, is I'm going to build a 30, 40, 50, $100 million company. I will own maybe like 90% of it. When I exit that for the same multiple as Silicon Valley companies exit for, I will get more, even though the dollar amount is smaller, the ownership is greater, and I actually make more money. It's a life-changing money. And it feels like it's a different game that a lot of people play in Texas, and they're perfectly okay with it, which I think is really cool.
Yeah, I totally agree with you. And not to mention the control, right? The more you raise and the more equity you give up, it also comes with you giving up some level of control. And so I think Texas entrepreneurs, because they tend to be bootstrapped, they like the fact that they're keeping control. And so I think it's not only the value of their equity, but the value of their control, which you can't really put a number on, but our companies, if they want to sell tomorrow, they have pretty much the right to do that, unless they have some angel investors that have some control rights. But it's a different game, like you just said, than the companies in California. They're trying to create and are creating huge businesses. I think the ones in Dallas, because they're angel-backed, self-funded, they go straight from angel to private equity or growth equity, and they miss all the A, B's, and C's in between, right?
It's interesting. Do you think so I think it's true in Dallas. You and I know this. Texas, definitely. We have 250 CEOs now globally that work with us directly, and then obviously much more on the YouTube channel. I see this just beyond Texas too. I think a lot of entrepreneurs are waking up and saying, I'd rather sell for 100 million and have 90% of that and be creative in my financing or be creative in my growth and do that other game. It seems like that's still a thing.
Yeah, I totally agree with you. I think it's, markets like Phoenix, Denver, and other markets I would say that are similar to Dallas. Those characteristics are very similar. And I would add to it where I think there's been a big lesson learned the last 6-7 months, where entrepreneurs raised quite a bit of capital at a very healthy valuation. And now they are required to sell for a large multiple of that last valuation, which I'm not saying they can't do, but given valuations are declining, et cetera, it's going to be somewhat of an uphill battle. I think it's just intuitive to try to raise a lot of money at the highest possible valuation, but entrepreneurs need to realize they will need to exit.
Yeah.
And that last investor needs to make a certain financial threshold that they're looking for as well. So everybody needs to win at the end of the day in a scenario like that. And I think sometimes entrepreneurs forget that. It's just intuitive to raise as much capital as I can at the highest value as I can. That could get you stuck.
That question of optionality and maintaining optionality, I think, is the most important thing for an entrepreneur. Because I don't think there's a religion around venture backed or bootstrapped or this or that. I think, I don't think about it. I've been both. And what I always tell people is look, as soon as you take 3 million, that means if a $120 million fund invested 3 million into your seed round, they're expecting to return the fund. Anything less than $125 million sale is not worth it for them. So you've just reduced the optionality on what you can exit for and lost control and equity. But that doesn't mean if you're crushing it and you get to say 3 million completely bootstrapped or through some other forms of funding that we're going to talk about, you now have the option to really raise a monster round if you think that market opportunity is there. But optionality is the real big thing that I think entrepreneurs are savvying up to, it seems. Not that one is right or the other.
The way we invest, which we'll go over in a little while, creates that optionality. Our companies that we invest in take our capital and they feed into one of three arenas. The first one is a strategic exit because they face little dilution. If a strategic comes in and buys them, that's a pretty healthy exit for the founder. The second one is a PE recap, where they sell a majority stake of the business, get some liquidity, but then they also get another bite at that apple. And then the third one is the growth equity round, where you're 4 or 5 million in revenue. We provide some capital. You use that, grow to 7, 8, 10 million in revenue. Now you've proven to the next investor, look, I got a couple of million from Cypress and Vic, and I put it into sales and marketing, and look at the engine working. Yeah. And I think intuitively it tells folks that the entrepreneur did whatever they could to avoid dilution. That really tells the world how much you believe in your equity. And so that's why we're such a great feeder into growth equity as well. So our companies tend to feed into one of those three things, but they don't have to make that decision today. They can make that decision 12, 18, 24 months after our investment, or just continue to run their business if they so choose to.
We do so much around how do you pitch? What's your pitch deck look like? What's the fundraising process look like? What's the black art of fundraising? Like, it really boils down to one thing. The more swagger you have, the more successful you're going to be. Swagger cannot be manufactured. It's purely from like, you don't need the money. It's upside for you. And that's when you're in a position of power and investors are coming to you and saying, hey, we want in on this business because clearly you know how to deploy $1 and get $2 back. Let's go. And so I think that traditionally, for the longest time, even now, I think entrepreneurs think there's this binary choice. I'm either bootstrapped or venture back, bootstrap, venture back. So maybe you can tell us a little bit around what is your form of financing, royalty-based? What does that look like? How does that work? Is it putting you in one of those two buckets? Is it a third bucket in the middle? Like, walk us through it as if we know nothing about it.
So we've coined the term royalty-based growth capital. And what that sort of means is, from a focus standpoint, we're not investing in startups. We're investing in companies 2, 3 million in revenue to about 15 million in revenue. So to a certain degree, they have product market fit. They've always had confidence they wouldn't be an entrepreneur if they didn't, but now they have a lot of data to support that confidence, and all the unit economics like CAC to LTV, churn, average contract value. So all these statistics and metrics that companies are tracking are heading in the right direction. And up until this point, they've raised maybe some angel funding, maybe a seed round, but they really aren't that 5, 10, $20 million raised business. And so they've hit this inflection point. And the earlier you dilute is going to be the most expensive dilution. That's just natural. It's just the way it works. And so our thesis is for you to avoid that or push that down the road. The companies we invest in can go raise equity if they want to, but they really don't want to for the two things that come with equity, which is dilution and loss of control. They really have a tough time getting bank debt because they are not venture backed and they're small and asset light. So they can't really find a place to get capital that's non-dilutive, but that also comes with help, et cetera, that you will get from an equity investor. And so that's sort of the problem we solve at the end of the day. And the way we do that is through royalty-based growth capital. And what that means is we invest 1 to 5 million and we have the ability to tranche it out. So you take what you need when you need it versus being required to take 5, 10, 15 million because of fund sizes. So we invest 1 to 5 million. And instead of taking a board seat in an equity position, the company starts paying us a monthly royalty, a percentage of revenue each month until a cap is hit. So it's a way for an entrepreneur to get the capital they need to further their product development, put capital towards sales and marketing, potentially even an acquisition, and take themselves from here to here. And then at that point in time, decide if they want to do one of the three things I described earlier, growth equity round, strategic exit, or a PE recap, or nothing at all. So, but given our backgrounds, they want folks to help them, advise them. And our entire team has an operational background. So we've sort of combined the best of debt, which it's non-dilutive, you're not giving up control, and we've combined the best of equity in that you're getting help, it's not personally secured, there's no covenants. And we've sort of put those two together and made now over 80 investments into 46 companies. So that at a high level is how it works.
It's so funny. Like, the marketer in me is like, royalty-based capital sounds awesome, but it's also like, to me, it feels like it's awesome capital. It's like you get the capital, you get the help, but you get no dilution, you keep control. And as you deploy that capital, you know your go-to-market machine will return that capital and give a percentage of it back, and then you're paid off. That's like literally how it works.
Yeah, and we come in when we call it the inflection point. The entrepreneur has hit this inflection point, and now they want to put some fuel on that fire. And so that's when we come in, when they're at their most confident, which is when you want to avoid any dilution. So that's when we precisely come in. And check size, right? 1 to 5 million. They really haven't had much capital because they've been bootstrapped, raised a seed round. So they really aren't looking for 5, 10, 15 million. They're looking for a couple of million to get themselves to the next level. So I think we're sort of hitting companies when they're sort of teenagers, I guess, if you want to call it that. And they're infusing them with the appropriate amount of capital to then bridge them to whatever they want to do next.
And one of the interesting things that you mentioned when we talked was you do SaaS companies, but you also do consulting companies. Is that right? Like, so what are the parameters around a consulting company? Is it different than the revenue bracket that a SaaS company has, or do you think about it differently?
Yeah, we definitely think about it differently because they're very different businesses. And the reason we are capable of investing in business services or consulting professional service business because we all come out of it. So we feel like we can assess it. In fact, today, one of our Fund 2 companies was acquired by IBM. So a strategic exit and
Today's a good day for you.
Yeah. So Dialexa, Dallas-based.
I pass the offices all the time.
Yeah, completely professional services and a strategic exit to IBM. Because our team comes out of professional services, we know how to assess those businesses. We know how to help those businesses. But because we also come out of SaaS and tech-enabled service, we can also help those businesses. Obviously, the metrics are quite different. You don't really have the notion of MRR and ARR, but if you do good work, your customer will continue to come back. And we're not going to invest in what I call a staffing business that maybe provides resources. We're going to invest in a higher margin, a niche player like a Dialexa that really differentiates themselves from others, and their rates, et cetera, sort of prove that differentiation out. So the bar from a revenue standpoint will probably be higher for a professional services firm than a SaaS business. We're more than comfortable investing in a $2 or $3 million SaaS business. We probably wouldn't be comfortable investing in a $2 or $3 million professional services business. We probably want to wait for them to be, maybe 4, 5, or 6. But I think their differentiation in the market is what will allure us to a professional services business. And a lot of them now have managed services tied into that. So they do have some recurring revenue type of stream at times, maybe not as high margin as a SaaS business, but still sticky, recurring, a decent multiple upon an exit. So we're starting to see a lot of that.
I want to take it in. We, as I mentioned, get a lot of founders that are coming from the services, professional services, consulting background. And they're like, look, great business, but man, I really would like to sell a product. And so then they get into product. A lot of times what you end up is not a true SaaS offering. You get some sort of a mix. You mentioned the keyword of tech-enabled services. I think the idea of productized services are starting to become more of a thing as these companies have a services offering, but now are having a product to go with that. So it's not always true SaaS revenue. So VCs will kind of not look at that seriously, but they're like, hey, this works. This is a great business. I want to invest in it. Can you tell us a little bit around how you think about those kind of businesses? Have you invested in any of those? Do you see them? What are your thoughts on those?
Yeah, we have invested in them. We see them all the time and we like them. There is something to having a profitable services business that is continuing to feed your software business. And oftentimes it is helping you sell the software too, because they're probably in the same industry, similar customer base, et cetera. But we've met companies that have been told, ditch your services revenue, go student body right on your software. And we don't really have that same line of thinking. We are completely open to a company having both, but with the end outcome being concentrating more on the software. But we think there is value to the services. It helps you sell the software. It's profitable. It's gotten you to where you are today. But most of the companies we talk to, they're putting, the capital we invest will go towards maybe growing that software piece faster, but by no means is it ditching the services revenue. Because I think the world is used to the value of SaaS is much higher, obviously. And then they put different multiples on the different types of businesses. at the end of the day. I don't think somebody will not want to acquire you or invest in you just because you have services business. If you are a high quality business that's growing nicely, yeah, you'll maybe get a lower multiple on the services and a higher multiple on the software, but I think you're still an attractive business. And some of our portfolio companies have proven that.
I think what you said about the common customer is super important. I do come across founders that sell to person A and they want to build a software company that sells to person Z, totally different zip code. And that's usually where it goes wrong. But if you're like, look, I already have 1,000 customers on the services side. Now I can sell those 1,000 people a product. That makes strategic sense for sure.
Yeah. I mean, if you are a consulting firm of some type and your industry or your vertical is healthcare, and now you've built a product because your customers have explained an issue that you can resolve. I mean, you shouldn't be in healthcare and all of a sudden selling a software to oil and gas. Those are completely different languages. And now you're selling two different, horizontals, right? You're selling one services and one software. So that wouldn't make much sense. But the companies we're investing in are staying in their lane, and maybe as they grow, going to other lanes as they expand.
Let's go into SaaS. You see a lot of companies, you've done a lot of these deals. What would you say is the top 3 reasons when a company is at the 2 to 3 million threshold at an inflection point, but you choose not to invest? So like in a way, like for the founders, what are the things they should really work on to make sure that they have this as an option as they're going into it?
Yeah, I would say one thing we really drill into is the unit economics. If it's costing you $1 to sell the solution and your lifetime value is $2, that's just, you're not making enough. You're not charging enough at the end of the day to be a sustainable business. I understand early on you need to, get some logos and the price point may not be what you want, but I think entrepreneurs tend to underestimate the value they provide to a client. And so their price point may not be reflective of the value. So we oftentimes see that entrepreneurs are undercharging or the price point is too low. And so it just becomes a difficult business to get the appropriate metrics. Your sales cycle, your cost of sales, if you're selling to the SMB space, you really can't be, not that anybody flies around anymore, but your sales cycle can't be long. You can't spend a lot of time, et cetera, because the price point is much lower, obviously in the SMB space. So the cost to acquire a customer versus the lifetime value of that customer needs to be, reasonable. If the LTV to CAC is too high, you're not spending enough money in sales and marketing. So you may be leaving some meat on the bone. If your CAC to LTV is too low, then you're spending too much money to acquire a company or you're not charging enough. So there's a fine line there. And that's one thing that we really drill into. The other one is, we're investing in a $4 or $5 million company. So they're not going to have per se a 5, 6, 7 person management team, but they're going to have a few people. And so we look for a sales oriented leader to be in the organization or have somebody identified to bring into the organization, because you really need that to sort of scale. And sometimes it's a CEO and sometimes it's not, right? But that's a formula that needs to be in place to get you to that next level, is having that person around you. And you may not have a CFO, but somebody fractional at that point in time would probably make sense as well. So that way all your financials are in appropriate order, right? Those are a few things, but at the end of the day, you're investing in the team. Those are the folks we want to get to know. I mean, like I said, that may not be 5, 7 people, maybe 2 or 3. And it's the ability for the CEO to attract other A players around him or her and then retain them. That's really key, is attracting them and retaining them, because if you can't, you're going to hit a glass ceiling of about 4 or 5 million and you're not going to be able to scale.
What I'm hearing is if you have go-to-market efficiency, and with that efficiency, if you could put in more capital at the top efficiently, it would churn out more cash on the other side. That's literally your holding point. And maybe there's some things like I need to spend a little bit more on a leader, but I have got that identified, and we need to spend a little bit more on this part of the machine. And then we know how to manage that cash. Like that's literally where you're like, hey, you should consider us versus giving away a bunch of equity. Because if you grow this a little bit more, and I think this is what I'm hearing, like if you grow this a little bit more, your ability to raise an equity round, let's just say a year from now or 2 after that round of growth, is way better than what you might get right now in the market, given dynamics or just where you are.
Yeah, I think you hit certain thresholds, right? When you hit 5 million in ARR, you graduate to a certain level. Once you hit 10 million in ARR, you graduate to a certain level. once you diversify your any client concentration you may have, if you diversify to other industries, all these things will be positive check marks for the company, right? And honestly, the bigger you get, the more you can control the terms and conditions of that next round, where you might give up more equity, but you may not give up as much control, right?
Yeah.
Or vice versa. You have a lot more leverage, I would say, if you're crossing that 5 million mark, especially if you're crossing that $10 million mark. And I think if you cross the $10 million mark, depending on what you do, you'll get strategic interest at that point as well. Because
Yeah.
strategics want to buy innovation versus build it most oftentimes than not.
And you own enough to be able to, and have the optionality to exit that out if you want to.
That's correct.
Yeah. It's interesting, like the math on your ability to skip around is wild. And I think that a lot of entrepreneurs don't know how to do the math on that. Like, let's just say you do a pre-seed round. If you can use your existing capital and go-to-market machine and royalty-based capital to skip the seed round or the A round, and you get to like 3 to 6 million, then you go for that B round, you just saved yourself easily 40% of equity dilution while you're able to scale and get the scale capital later on if you want to.
Yeah, I mean, you're exactly right. I mean, you can just use the numbers. You're 3 million in revenue, you take our capital, get to 10 million. Not only are you bigger, but your multiples are also going to be quite bigger. It's just, it's inevitable. The companies we've invested in after us have created 2.2 billion in enterprise value after us. And it's created more than 300 million in wealth for our entrepreneurs that potentially could have gone to equity investors. So I feel like we sort of level the playing ground to a certain degree. I mean, you're exactly right. We sort of make them skip that middle step or that second step or whatever step you want to call it.
I've dealt with venture debt before, and you're right. Like, venture debt is there only when you don't need it. Basically, it's like, oh, you just got 15 million from Andreessen Horowitz. Here's some venture debt. You want it? And you're like, maybe. Covenants on that are crazy if things do go south. So it does get kind of risky with that kind of thing. But it's also just there, and they're just bankers. One of the things that I thought was interesting is you all come from operating backgrounds. Can you tell us a little bit around beyond the cash? How else do you guys work with the founders as you, like, on the deals that you've done? Even, you mentioned one exited today, one deal closed today. Like, what was the experience like for the founder side on how you engage with them? Like, what else can they expect beyond the check?
Yeah, I mean, I think this sort of gives you a data point on that. Our newest partner on our team, who joined about 2 weeks ago, was an early employee of a company we invested in.
Nice.
And then he took our capital in lieu of equity and other options, did a growth equity round, hired an investment banker amongst many, and then sold the company to LLR. So that person is on our team, and we've worked with him for the past 10 years as a portfolio company. And so I think that gives you an example of some of the value we can bring to our companies. But typically when we invest, they're using a good amount of our capital towards sales and marketing. And so that's where we typically help day one, is helping them think about their sales and marketing strategy. How can they maybe do it better? Have you thought about channels? Just other avenues to help them sort of think outside of the box. I mean, they're sitting there day to day. So it's sometimes nice to have an outsider come in and provide their thoughts. And we have, 46 companies that we've helped in this regard. But that's where we typically start when we make an investment, because that's where the need is. And then, oftentimes our companies are acquiring other companies. And so we definitely help them assess the business they're acquiring. They definitely lead into M&A activities or growth capital activities, right? So we participate in their thought process on capital strategy. Should they raise growth equity? If they get an offer, we sort of work with them on the waterfall, as well as just the end outcome, the culture fit, things of that nature. So it typically starts with sales and marketing, and then sort of graduates to capital strategy, M&A, growth capital, et cetera. And then not to mention, we do the things ad hoc, like making introductions to customers and things like that, interviewing key hires. What we like to say is we do the things that a board member does, but obviously we're not on your board. So it's more of an opt-in, opt-out. And we take your cue on when you want to send, when you don't. And that sort of ebbs and flows, and they sort of appreciate that.
I think that's the other interesting thing. You do a seed round or a Series A round. We've had founders that had 2 board seats given away at their seed round. And I'm like, why did you do this? And a lot of strings come attached for these kind of things as well, for not a lot of cash either. So it is another one plus side of this, of keeping the control. You mentioned go-to-market. That's one of the things, this is what we do at Unstoppable. It's top of mind for every CEO these days, more than ever, given the saturation of channels, like actual channels, not channel as a strategy. But what are the big things you're telling your portfolio companies right now in terms of go-to-market? Like, is there one big thing that you're like, you know what, we really want you guys to focus on this because it's an unfair advantage? Or what have you seen as you're guiding these companies and making sure the money you give them, they're deploying it into sales and marketing effectively?
Yeah, it sort of depends on the company, right? So if you are selling an enterprise solution, then that strategy is going to be wildly different than if you're selling to SMBs or something like that, right? So some of our companies have had wild success in content marketing, digital marketing, things of that nature. So I think generally speaking, that has definitely increased across the board and just creating awareness of their solution and being able to feed information to the appropriate buyer. And selling to this size business versus this size business is different. You can't sell the same way to lower market as you can to middle market or enterprise. So we're sort of working with our portfolio companies on, okay, now you're moving upstream to enterprise. Well, what you were doing before is probably not the best way to potentially sell into the enterprise because it's a longer sales cycle and it might be more competitive, or you're maybe displacing an incumbent, et cetera. So we sort of work through those things. And honestly, oftentimes the entrepreneurs, because the team is small, they're so busy just doing everything, they don't really understand the metrics themselves. And because of our team, we're able to provide them metrics on, well, this group of customers for you is not only churning less, but they're actually growing the price point. So you might want to spend a little bit more time here, but they don't really have the time or the talent on staff to really, dice up all the data to really understand that. So that's another thing we bring to the table, is providing all this churn analysis, et cetera, for them to get an understanding of what their churn really is. Because we'll talk to an entrepreneur and they'll tell us their churn is X%. But once you start digging in, it may be X%, but that is, you're losing your smallest clients, but your bigger ones are actually getting bigger. The metrics are actually quite positive, but they're explaining it to you in somewhat of a negative way, right?
One of the things that I find amazing is, like, a lot of founders, no one's fault. I was guilty of this too. We don't do the math. The nature of SaaS businesses, the nature of some of these tech-enabled businesses it's very predictable math. If you do the math, you can start to understand where to double down, where to cut off. And a lot of times people just don't even do the math to know that certain segment of the ICP, ideal customer profile, yields better. We've had companies, you mentioned pricing before, like we've had companies that have increased tripled their prices and their win rates went up. Some of these basic things around go-to-market make a huge, huge difference for sure. When you do the math and you start to tweak some of these knobs, which you can only do when you're looking outside in. When you're in it, it's hard to do those things.
Yeah, I think it's, and that's a great point, where you triple the price, but then the buyer thinks higher of you because of that, even though nothing has changed.
That's right.
Besides your price point. They just don't put you in this bucket with everybody else. They put you as a higher quality solution.
Yeah, it is funny. No one wants to buy the cheapest software. Like, they're trusting you with a core business process or some core function. Their success in their role depends on it. They're not looking for the cheapest, they're looking for the best, and they're willing to pay appropriately for it if you can provide the value, which I think is easy to forget when you're creating the software. And what's the best way to connect with you or learn more about your firm, and like what's the best way to get in touch?
Yeah, just shoot me an email. My email address, I think, is on our website under the team page. I'm pretty active on LinkedIn, so if you do shoot me a LinkedIn note, I'll most likely respond to that as well.
Yeah, awesome. Well, I think we're going to wrap here. Thank you, everybody, for joining. Vic, thank you for joining. I will see you soon because we both live in Dallas, which is awesome. Thank you, everybody.
Thanks, TK. Thanks, everyone. Bye-bye.
So now you know what the 3 models of funding your SaaS growth is. Number 1, you can bootstrap it using customer revenues or proceeds from another business. Number 2, you can give away 20% of your company roughly and raise venture capital every single round. Or number 3, right in the middle, you can do revenue-based financing or royalty-based financing. These are all different options. There's no right or wrong. It really depends on the type of SaaS business you're building, the type of go-to-market machine you have, and exactly how you want to drive growth for your SaaS business. This is also one of the things that I deal with on a regular basis when I'm working with founders inside my SaaS go-to-market coaching program. Inside this program, I help you build efficient and predictable go-to-market machines so you have the optionality of funding your growth the way you want, whether it's bootstrapping it or raising revenue-based capital or raising venture capital. We have all 3. We have over 250 founders that we work with inside of my coaching programs, and they're coming in all kinds of shapes and sizes and funding profiles. So if you want to learn more about it and the go-to-market program and working together to actually build your efficient go-to-market strategy so you can actually drive growth, then just go to getunstoppable.com/GTM. Getunstoppable.com/GTM. You get all the details over there. And also, if you want to get in touch with Vic, if you feel like you fit his profile of exactly the type of company he wants to fund, which he shared in this episode, all of the details for reaching out to them and learning more about Vic, connecting with him on LinkedIn, and also Cypress Growth Capital Partners is all below in the description. Also, if you got value from this video, please smash that like button for the YouTube algorithm. It really loves it when you do that. I drop an episode every single Sunday with actionable strategies and tactics on how to grow your SaaS business faster. I also sometimes drop an episode on a Thursday inviting experts in the SaaS space like Vic to share their principles on how they see driving growth for SaaS businesses. So if you got value from this, please smash that like button and also hit that subscribe button and that bell icon. That way you'll get notified every single time I drop an episode. If you have a fellow founder or team member, part of a Slack group or a WhatsApp group that will get value from this episode, please share this with them as well. And lastly, remember, everyone needs a strategy for their life and their business. When you are with us, yours is going to be unstoppable. I'm TK, and I'll see you in the next episode or inside of the Go-to-Market program.
Give me 1 second. Just move this. All right, awesome. That is totally not my bag, but